Okay, people, your boy is back. Noah Cash is back. Took a break on the weekend, but we are back, and today we're talking about QQQI, and we're going to do a deeper dive into this product, QQQI by Neos, looking at its distributions, how covered calls work, its tax structure, and then comparing it to a JEPQ, QYLD, and other related funds. So let's jump into a slide deck explaining covered calls and some of the benefits of QQQI. Okay, folks, so let's start by understanding what a covered call is. Investopedia put up this cool chart, this cool graph for us. An options trading strategy. A covered call is an options trading strategy in which the trader sells the call option while also owning the underlying security or asset. Okay. And in the case of QQQI, what they're doing is as follows. They own the asset. In this case, they own the top 100 stocks, or the NASDAQ 100 rather, via QQQI. And what they're doing is selling these call options um, that are considered out of the money. We'll explain what that is in a moment. And to sell these options while owning the underlying asset, what happens is you get to earn a little premium, a little income by selling these options. And really, this income is ours to keep no matter what happens with the stock. It's kind of a bet that you're making if the stock will be sold or not at a certain price. And what does that mean? What does that look like? Well, QQQI sells out of the money calls. In this case, the what's called the strike price, the price to sell, and the price that they're predicting, it's going to be higher than the current price of the underlying asset. Okay. Um, they're setting this up for other people to potentially purchase these calls. And what happens is if they set up this out of money call that again is above the price of the current value of the stocks, and setting that up, they will earn a premium, earn a little income as a result of that. Now, if the price of this NASDAQ 100 portfolio stays below this strike price that they've outlined, those out of the money calls are worthless, and so you don't have to sell any shares. But QQQI keeps all the income from selling that covered call and keeps the underlying stock. So effectively, you just get income um, with that scenario. If those underlying assets rise above the strike, well, your shares get called away. So you'll have to sell your shares, but you're selling your shares at a gain effectively, right? Maybe not the exact gain that you would have seen should you have held the underlying stock entirely. But what happens is you get to keep that initial income that was provided by that covered calls option offering. And then you get to the QQQI will receive some of the upside by selling the gain at that strike price, right? And so they can then recycle and repeat and reissue a new out of the money call option to regain new income and then ideally it really doesn't hit the strike, but even if it does, they get those gains. Um, and this is why the strategy is quite conservative. It's quite reasonable in that, either way, whether you hit the strike and have to sell, you're selling for a gain, or you don't hit the strike, you're going to get your income nevertheless. So I think it's quite a healthy strategy. And of course, if the stock underperforms, if it goes down, then all things are treated equal. You will, the price of the assets will go down, the ETF value will go down, but so will the underlying assets like QQQ itself would go down. What's even more interesting about QQQI is its tax treatment. A good portion of its tax structure is considered what's called return of capital. Return of capital, and that's kind of a new term, not to be scared of. This is kind of just how the distributions are classified. It's not necessarily them giving you back your assets. It's a classification structure. As well, they have unique structure as it relates to the rest of the tax, the rest of the distributions by way of Section 1256, which are favorable tax structures for those as well. So what this means is, let's say you invested $10,000 in QQQI, your annual distribution is going to be $700, let's say. $686 will be a return of capital, and 2% or $14 would be taxable at this 60% long-term rate. What is return of capital? Well, that's effectively deferring your taxes until you sell. It's reducing your cost basis of your purchase, the cost basis of the asset you purchase, and so you're deferring your taxes until you sell. So when you sell, it's almost like selling with a major capital gain. When you sell, you'll get hit with that tax bill, but it allows for you to kind of treat this like QQQ itself, QQQ, because now you don't have to worry about those annual taxes as much. And look into this yourself, and certainly speak to a professional as relates to the tax efficiency here and tax strategy. But as far as I'm aware, this is the kind of the structure. So that's kind of it in a nutshell, the two major benefits of QQQI as it relates to its tax efficiency and what a covered call looks like. And really, when we go to QQQI, we see that it has that beautiful 14% distribution rate, annual distribution rate, with a fairly higher expense ratio. But again, with a 14.56% distribution rate, we can handle this expense ratio. As we spoke on, the fund is seeking to generate high monthly income for its constituents by investing in the underlying assets of the NASDAQ 100. And it's doing a really good job at tracking the NASDAQ 100 along the way. If we look at a comparable asset, if we look at JEPQ, which is JP Morgan's NASDAQ 100 covered call, there is a slight advantage for JEPQ by way of expense ratio. And they also have a lot more assets under management. But I would venture to say that QQQI is the stronger option for us. Number one, let's look at the total returns of both assets over the past year. And QQQI is a fairly newer asset, but I like how it's being managed. So overall, when we look at total return, QQQI does considerably beat JEPQ by approximately like 6% year for the past year, right? And that matters. That matters. So which one would you rather have, the 21% yield or the 27% overall yield total return? I would go with the QQQI, which is 27%. And then if we look at like price return, QQQI, stronger just overall appreciation and price return, healthier price return there. So that increase there in that comparison there is good by me in that way of affording the extra MER that you have to pay for QQQI. I think that's a healthy trade-off and a worthy trade-off for me. We can even add in like QYLD if we want. Compare those. Let's compare with QYLD and look at the difference there with QYLD. QYLD, the price return has been negative for the past year, negative, and we don't want that. We want these assets appreciating or staying flat, because with the higher appreciation, you're going to actually see dividend growth potentially, even if it's stable at 14%. If it's a higher asset value, your dividend is growing. Whereas QYLD is flat, if not negative 0.65%, so their dividend will be decreasing. And look at the total returns. So over the past year, QYLD has done 12% in 1 year returns, total returns, whereas QQQ, of course, QQQI has done 27%. So much healthier in QQQI. To be honest with you, I don't like Global X too much. NEOS to me is the GOAT right now for me. Very, very green here. All good there. Um, yeah, I mean, for me, and if we even look at QYLD from from a 5-year standpoint, their NAV has been declining, declining NAV. Very scary. And so we don't want to see that. We want a growing NAV or a stable NAV. So for me, QQQI is a very strong option if you are wanting monthly income in a tax efficient manner, um, with a stable, if not growing NAV. And so yeah, QQQI for me is the number one. Okay, guys, are you invested in QQQI? If so, leave a comment down below letting me know your strategy. Also, if you want financial coaching, if you want advice, I have a Patreon that you could sign up for. I do a monthly session for you as well as unique content, and I'm going to keep growing that Patreon. So if you do want to join up, let me know by signing up to the link I'll add to the description. Outside of that, guys, all the best, peace, and we'll see you tomorrow.